When talking about investing in today's market, you are likely hearing more and more about opportunities in bonds. Investment-grade corporates come to mind as that market continues to heat up. But are they still hot today? And what about the preferred market? What should you be aware of there? Find out right now on UBS Trending. Hello again, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you for joining me today. From the Chief Investment Office, two of my colleagues, Barry McAlinden and Frank Saleo, are here to join me to talk about what's going on both sides of the bond house. We're talking about preferreds, talking about investment-grade corporates. So, guys, thanks for being here. Barry, I want to start with you with investment-grade corporates. You were here with us back sometime in February, and the IG corporate market was heating up a lot. Is it still hot right now?
It is still hot, believe it or not. So yields are still about the same levels as they were when I was here back in February. We're up about 5.5% for the IG corporate index. But we did have some significant regional bank failures that happened, since that time. So there has been this re-rating, like within IG, specifically financial credit spreads have widened relative to non-financials. And that marked a shift in their relationship. Instead of trading at lower spread levels to the non-financial counterparts, they're now at wider levels. And financials they're a big driver of investment grade spreads overall. I mean, weighting wise, they're close to about 50% of IG. So IG yields are consequently about the same, even though treasuries yields are down over that time, but spreads have widened a bit. And you have this, within the index, a pretty significant repricing that's taken place.
So still pretty attractive right now at these levels, right?
Indeed, yes.
Yeah, great. Thank you, Barry. Frank, let me bring you in. We did a special regional bank call a couple of weeks ago. You were on that with us because preferreds certainly were an area of the market that were being impacted. And I know you received a lot of questions from our advisors and our clients. So where are we right now with preferreds, especially even versus a few months ago or a year ago, especially as Barry's talking about yields on the Treasury side have kind of been all over the place?
Yeah, preferred investors just can't catch a break,
right.
Really. I mean, coming off of 2022, the preferred sector experienced one of its worst performing years in decades, and that, of course, was driven by interest rate risk and the epic surge in Treasury rates that we saw last year. But the fact of the matter is 2022 was a pretty difficult year for most fixed income sectors and even equities as well. This year, we found preferreds got off to a good start in January, but experienced significant drawdowns in March and then again more recently in May, attributable to those regional banking concerns that you referenced, and most preferreds are issued by banks. So like I said, it seems like the preferred market can't catch a break. But the silver lining is that valuation has improved. Last year, as prices declined, yields rose for preferreds, and we ended the year with the average preferred yield above historical averages, but still in line with on a relative basis, because again, everything was down last year. But given the disproportionate weakness this year, the relative valuation in the preferred sector has improved as well. So the silver lining to all this, Anthony, is that preferred valuations are now more attractive on both an absolute basis and a relative basis.
Terrific, yeah, and we saw that in the chart there, Frank, so thanks for providing that for us. Back to IG corporates, though, Barry. Obviously you said it's a good time right now, but what are the vulnerabilities here when it comes to investment grade?
So I think in vulnerabilities, we're thinking about basically the economic and macro environment ahead. Tighter financial conditions certainly have put stress both on financial companies as well as non-financials. I think as it relates to the bank, we do think that the issues with the regional banks were very much idiosyncratic. The larger banks are in bigger position, to withstand, I think, some of the stress. Not to say that they're going to, come totally unscathed, but overall, generally, quite comfortable with their credit profiles. And then for non-bank type companies, when you're talking about those within investment grade, these are kind of the large cap, companies that reside in the equity market. And again, they have, the scale the business presence to withstand, these higher for longer costs. They've largely termed out their debt. So, we think that investment grade, remains in a good spot, to face the kind of the economic uncertainty that lies ahead.
Right, and any potential stresses, obviously, that might come our way. Obviously, we don't know quite yet exactly what the Fed will do when it comes to rates. Anticipation is that they will keep rates unchanged. We'll see, obviously, as financial conditions might change, et cetera, et cetera. So lots to talk about. I feel like every time we have you in here, I'm like, yeah, but what happens next? But we just don't know if only the crystal ball we had worked, right? So Frank, kind of a similar question to you. Back on the preferred side, what are some of the vulnerabilities, some of the risks that exist there right now? And does it have to do with the regional banks? As Barry said, it's pretty idiosyncratic. It doesn't seem like it's a systemic issue.
No, well, preferreds have certain unique risk characteristics that investors need to be aware of. Of course, you do get compensated for those extra risk factors. I like to look at a bank preferred's yield premium relative to that same bank's bond yield premium. And we often find that when it comes to the preferred yield premium, and I mean the bank, the preferred yield over Treasury, oftentimes it's 2 times greater and sometimes more than that same bank's bond yield premium. And the reason for that is because you're getting compensated for some of the risks inherent in preferred. So most notably, people invest in preferreds for the yield, but it's important to keep in mind that preferreds rank below all forms of debt. They're below bonds in the corporate capital structure. If something goes wrong, the preferred shareholder is in the back of the line when it comes to a claim on assets and cash flows in some sort of insolvency or default situation. Preferred coupons are completely discretionary, so these are some of the unique credit considerations to keep in mind. Also, when it comes to interest rate risk, bank preferreds are potentially perpetual, but they could also be redeemed at any time at the issuer's discretion once we get past a non-call period. So that makes interest rate risk somewhat a unique challenge.
Sure.
But overall, as I said, you do get compensated for those unique risks with those expanded yield premiums relative to the same bank's bonds.
Right, and as you showed, those yield valuations are pretty strong right now.
Yep.
There you go.
Been
Okay.
improving, so.
Right. Thank you, Frank. So we're just getting to the end of our conversation. I want to wrap it up with both of you. Barry, I'll ask you first. Where are the investment opportunities right now, particularly in IG?
So we think presently in IG, there's an opportunity to extend out duration for investors who may not have already done so. Specifically in maturities that are around 7 to 10 years. And we think, over time, based on more of a downward path of interest rates, if we overcome some uncertainty in credit spreads over the near term, as we get into kind of a new economic cycle, you could see in the Fed eases, yields on corporate bonds, do decline historically. Right. So not only are you getting that income, the coupon income, but the prices on your bonds over the holding period, have potential to rise. So we would, advocate moving out the curve, again, not just staying on the real short end, where obviously yields are attainable there too, but moving out and really locking those in for, several years to come.
Thank you, Barry. Frank, same question on the preferred side, investment opportunities?
Yeah, definitely. I think you could make the argument that when it comes to regional banks, the risks have incrementally risen, but not so for the big banks, the big six, the big money center banks, the so-called banks that are too big to fail. The risks inherent in those larger banks haven't necessarily changed much since the beginning of the year, but yet valuations of their securities have improved as well. As Barry mentioned, we've seen yields on even the largest banks increase, and those yield premiums I've referenced earlier increased even more for those same banks' preferreds. I think of it as sort of like a telescoping effect. You had the yields improve for the bonds, and then even more for the preferreds.
Right.
So I think that's where the opportunity lies. And keep in mind also, most banks' preferreds trade at a discount to their par value. So you buy the preferred today, you're getting a fairly attractive yield based solely on that coupon, but the discount to par represents an inherent or built-in price appreciation potential. So if we look at yields on a yield-to-call basis, in some cases, taking that discount into consideration, we're looking at yields on a yield-to-call basis of double digits. So again, relative to the same bank's bonds, a pretty attractive yield premium in many cases.
Terrific. Thanks, guys. By the way, I love sound effects in a show. Yes, and it was the cartoon version of a telescope. Yeah, not a real one.
I just picture you on the crow's nest
right.
of your sailboat.
With a pirate eye patch, of course, the whole
land
parrot on my shoulder. I like it. Thank you, Frank. Thank you, Barry. Great to see you both. Again, we're talking about on this particular conversation, we want to bring attention to the message and focus, which is to buy quality bonds and income, which IG corporates particularly fit really well in, given the environment that we're in. So thanks, guys. Good to see you.
Can I also mention?
Yes.
I also published a report called Top Picks, Top 10 Best Buys, that explicitly list 10 ideas in the preferred space that meet the criteria I just referenced in terms of the big six banks with real attractive yields and price appreciation potential.
Terrific. Thank you, Frank. Yeah, and if anybody would like any copies of that, you can visit our website, ubs.com/views. That's our insights page, or your UBS financial advisor can certainly share that information with you and those reports, especially the one that Frank just mentioned. So take a look at the website first and foremost. Also, follow us on social media, particularly our brand new Instagram channel, UBS Trending. There's lots of content up there, including never-before-seen footage that we didn't get time to get to here on the regular show. So lots of great content up there for you as well. In the meantime, everybody, talk to your financial advisor if you have any questions about what Barry, Frank, and I spoke about today when it comes to your portfolio. Until next time, I'm Anthony Pastore. Have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.